The word fiduciary has become a buzzword in the financial industry over the last few years, but what does it really mean? An investment fiduciary is a person or entity that has a legal and ethical responsibility to act in the best interest of their clients when managing their investments. This obligation requires the investment professional to prioritize the client's interests above their own when making decisions related to an investment strategy, financial planning, or other related service. It may seem like common sense, but believe it or not, some financial professionals are not fiduciaries, and today I will explain the difference. Hi, I'm John Gigliello, and you are listening to Invest in Knowledge, a podcast about all things financial. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Only through education, action, and accountability can you build the confidence and security that you need to live a satisfying life. Today I'm going to explain what it means to be an investment fiduciary, why you might want to consider working with one, and how to determine who is and who is not a fiduciary. Now, let me start by saying that in my practice as a certified financial planner with the Albany Financial Group, I am an investment fiduciary. Clients are always welcome to ask me about that and what it means for them specifically. It's a question that I get all the time. Don't all advisors act in the best interest of their clients? Well, most probably do, but not all are required to. That's what separates investment fiduciaries from other advisors. So investment fiduciaries have 5 key obligations. Number 1, the duty of loyalty. The fiduciary must avoid conflicts of interest and ensure that any recommendations or actions taken are made with the client's best interests in mind. 2, duty of care. The fiduciary is required to act with competence, diligence, and thoroughness when providing advice or making investment decisions. This includes conducting appropriate research, understanding the client's financial goals, and aligning their advice with the client's risk tolerance and investment objectives. Number 3, transparency. Fiduciaries must disclose all relevant information to their clients, including any fees, potential conflicts of interest, or risks associated with their investment recommendations. 4, acting in good faith. Fiduciaries are expected to act honestly and avoid any deceptive practices that could harm the client's financial well-being. And lastly, number 5, ongoing monitoring. A fiduciary's responsibility extends beyond the initial advice or investment selection. They must also monitor the performance of the investments and adjust as needed to align with the client's best interests over time. Much of this may seem like the behavior you would expect from anyone with whom you entrust your life savings. But as I mentioned, not all financial professionals are fiduciaries. Some operate under what's known as a suitability standard, which only requires them to recommend investments that are suitable for the client, but not necessarily in the client's best interest. An advisor operating under the suitability standard can recommend products that pay them commissions even if a better option exists. Their recommendations just need to be suitable for a client's financial situation. They do not have to be the best option available. Fiduciaries, on the other hand, are held to a higher standard of care. Fiduciaries are legally bound to provide advice and make decisions that benefit the client, even if it reduces their own compensation or requires them to forego certain incentives. Now, there are 3 types of fiduciaries in finance: registered investment advisors, or RIAs, and they are required by law to act as fiduciaries. They are often fee-only advisors, meaning they charge a flat fee or a percentage of assets under management and do not earn commissions on the products they recommend. Certified financial planners. CFPs can also be fiduciaries if they are committed to acting in their clients' best interests and following both ethical and legal obligations. Trustees. A trustee managing a trust for beneficiaries must adhere to fiduciary standards, ensuring that the beneficiaries, not the trustee, profit from the trust assets. 401k plan advisors. Advisors managing company retirement plans are often fiduciaries under the Employee Retirement Income Security Act, better known as ERISA. This means that they must act in the best interest of plan participants. As an accredited investment fiduciary and 401k plan advisor, I fall under the guidelines of a fiduciary in this category as well. Now, let me give you some examples of when an advisor's fiduciary duty might come into play. With portfolio construction, fiduciaries must design investment portfolios that reflect the client's objectives, risk tolerance, and time horizon. They must carefully consider asset allocation, diversification, and the potential impact of fees and taxes on return. When it comes to investment selection, fiduciaries are required to choose investments that align with the client's goals, ensuring that each product is in the client's best interest. They cannot simply recommend products with higher commissions, incentives, or recommend their broker-dealer's proprietary products if better alternatives exist. Ongoing monitoring of those investments is a must. Fiduciaries are not permitted to set it and forget it. They have an ongoing responsibility to review the performance of the portfolio, make necessary adjustments, and ensure that the investment strategy remains aligned with the client's evolving needs. Receiving this kind of fiduciary advice can truly impact your investment outcomes because the advice will consider your long-term financial goals rather than short-term gains for the advisor. Fiduciaries are also more likely to recommend low-cost investment options, such as index funds or exchange-traded funds, better known as ETFs, which can reduce the drag of fees on your portfolio performance. Knowing that your advisor is legally bound to act in your best interest can provide greater confidence and reduce concerns about potential conflicts. A fiduciary relationship provides greater trust and accountability. It emphasizes ethical behavior, sound financial management, and transparency, all critical to protecting your financial well-being. So, how do you find and choose a fiduciary? First of all, don't be afraid to ask. The simplest way is to ask your advisor directly. Are you a fiduciary at all times when advising me? Some advisors operate as fiduciaries in certain circumstances, but not others. For example, they may act as fiduciaries when offering financial planning advice, but not when recommending specific investments. Look for fiduciary certifications, such as the Certified Financial Planner, Chartered Financial Analyst, Registered Investment Advisor, and Accredited Investment Fiduciary. You can check the advisor's status through regulatory bodies like the Securities and Exchange Commission, SEC, for RIAs, or the CFP Board for CFPs. It's also important to understand compensation structures. Ask how your advisor is compensated and review their compensation structure carefully. Fee-only advisors charge a flat fee, an hourly rate, or a percentage of assets under management. This structure minimizes conflicts of interest because they do not earn commissions. Fee-based advisors, on the other hand, may also earn commissions from selling financial products, which can create incentives to recommend products that may not be in your best interest. Look for transparency. Fiduciaries should clearly disclose their fees up front and explain any potential conflicts of interest. Request written confirmation of fiduciary duties. Now, some advisors will explain their fiduciary duty in writing, giving clients additional assurance of their legal obligations. Always check for disclosures. Review regulatory filings such as Form ADV, which outlines how an advisor is compensated, any potential conflicts of interest, and any history of disciplinary actions. Very important, Form ADV. Question their investment process. Ask your advisor how they select their investments and structure their portfolios. Fiduciaries base their recommendations on your financial goals, risk tolerance, time horizon, and other personal factors. They should also be willing to explain why they chose certain products over others. Try to avoid commission-driven products. Be cautious of advisors who push high commission products like certain types of mutual funds, annuities, or insurance policies, especially if they can't or won't clearly explain the rationale behind these recommendations. Also, expect regular reviews. Fiduciaries have an obligation to monitor your investments and financial plan, adjusting when necessary to ensure they remain aligned with your goals. Ask your advisor how often they review your portfolio and under what circumstances they make changes. Also, seek proactive communication. A fiduciary advisor will typically reach out to you periodically for reviews or updates, especially when market conditions shift or significant changes in your personal financial situation occur. Watch out for these red flags. High commission products. If your advisor heavily promotes products like certain mutual funds, annuities, or insurance products that come with high commissions, this could indicate a conflict of interest. Lack of fee transparency. If your advisor is vague or unclear about their fees or the cost associated with investments, it could be a warning sign that they are not acting in your best interest. Minimal explanation of recommendations. A fiduciary should be able to clearly articulate why they're making specific recommendations. If your advisor struggles to explain their choices or doesn't seem to be tailoring advice to your specific needs, they may not be acting as a fiduciary. In summary, to determine if your current advisor is a fiduciary and operating with your best interest at heart, focus on these 4 things: clear and transparent communication, written confirmation of fiduciary duty, reasonable and fully disclosed fee structures, ongoing monitoring, and regular updates. By carefully assessing these factors, you can determine if you are working with an advisor who is legally and ethically bound to help you achieve your financial goals. We hope this gives you a better understanding of fiduciaries. If you have further questions on this or any financial planning topic, we are here to help. We always encourage you to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about your accomplishments. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If you found value in this episode of Invest in Knowledge, I encourage you to please share it with your friends, family, and colleagues. Thanks for listening and make it a great day. The facts and figures for this episode were derived from a MarketWatch Guide survey published on August 7, 2024. John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. This material is for general information only and is not intended to provide specific advice or recommendations for any individual. Individual tax and legal matters should be discussed with your tax or legal professional.